Welcome to PayTech Talks, our new podcast where we explore infrastructure, innovation, and market dynamics shaping modern payment ecosystems. We will bring together experts and industry leaders to turn complexity into clarity and insights into actionable perspectives across the global payments landscape. In this first episode, we're joined by Duke Ballantyne, Regional Director for Eastern and Southern Africa at MS Solutions Group, to explore a critical question shaping the region. Why is infrastructure now the real gatekeeper for South African Reserve Bank authorization? Let's dive in.
I get asked a lot, is regulation in African fintech getting harder or just more serious? And my answer is always the same. It's not harder. It's just finally catching up with reality. I'm Doug Ballantyne. I've been working in payments across Africa for a long time now. And what's happening with SARB right now is genuinely significant, not just for South Africa, for the whole continent. So let's talk about it.
Why is SARB introducing stricter authorization now?
Why is SARB doing this now? The short answer is the market grew up. When you've got non-banks holding client funds, processing millions of transactions, operating inside the national payment system, you need proper rules, and SARB has written them. There's a two-tier licensing structure now. Tier 1 for larger operators, above 5 million rand in average monthly transactions, and Tier 2 for smaller players. Different capital requirements, different obligations. But here's the part that really changes things. For the first time, non-banks can hold client funds and operate payment activities without needing a bank to sponsor them. That's a big deal. It opens the market, but it also raises the bar considerably.
Can you tell us what are fintechs getting wrong when preparing for authorization?
What are fintechs getting wrong? I see this pattern constantly across the region. A fintech launches, they move fast, which is right, they have to. They stitch together a system, one provider for switching, another for fraud, a separate reconciliation tool, external KYC, manual dispute handling. And it works until they sit in front of a regulator, because then the regulator asks one question that changes everything. Can you show me end-to-end control of every transaction? And if your infrastructure is fragmented, that answer becomes very uncomfortable very quickly, and it costs you. Fragmented systems can add anywhere from 20 to 50% to your processing costs. That's before you even think about regulatory burden.
What does operational readiness actually mean, Duke?
People hear operational readiness and think it means having the right policies in place. It doesn't. SARB wants to see live capabilities. Can you reconcile in real time? Can you produce a full audit trail? Can you detect and respond to fraud dynamically? Can you manage a dispute from start to finish? That's not a policy document. That's infrastructure.
Why is interoperability becoming a licensing requirement?
Why does interoperability matter so much? Here's something that surprises people who are new to African payments. The continent's not just one system. It's dozens of systems running on different standards at different stages of modernization. South Africa moved to ISO 20022, but plenty of neighboring systems are still on ISO 8583. Others use proprietary formats entirely. And the regional platforms that matter, PAPS, TCIB, they're built on ISO 20022. 19 central banks, over 150 commercial banks. That's where the cross-border opportunity lives. If your platform can't connect to those rails, you're not just behind technically, you're locked out commercially.
Can you tell us how are regulators redefining risk and anti-money laundering expectations?
This one's important, and it's personal for South Africa. The FAT of grey listing wasn't just embarrassing, it was expensive. Correspondent banking relationships were terminated. 70% of cross-border remittances in the SADC region ended up going through informal channels. That's the real-world cost of inadequate AML infrastructure. So when SARB looks at your risk framework now, they're not asking if you have rules. They're asking if those rules are adaptive, auditable, and genuinely effective. Machine learning models, configurable risk policies, full decision audit trails. That's the standard now.
Where do most fintechs hit the wall?
It's almost the same place. Build, scale, apply for the license, then discover the gaps. And at that point, rebuilding core payment infrastructure takes 12 to 24 months minimum. That's not a technical problem anymore. That's a strategic crisis.
Is infrastructure now a strategic decision, not a technical one? Can you explain to us further this?
Completely strategic. And the fintechs that understand that early are the ones winning. The mindset shift I'm seeing in this market is this: from we'll sort compliance out when we need to we build for compliance from day one, because that's faster and cheaper than retrofitting it later. Infrastructure determines how quickly you get authorized, how easily you expand, how much confidence your partners and regulators have in you. That's not back-end. That's your competitive position.
How does Spark address this infrastructure gap?
Let's look at a different model. Instead of stitching systems together, what if compliance is built into the core architecture? That's the Spark approach. End-to-end processing, switching, issuing, clearing and settlement, fraud prevention, scheme connectivity. Built-in compliance with PCI certification across the full stack, with real-time reconciliation across ATM, POS and mobile, with integrated dispute management. And importantly, this is proven at scale, with 300 plus clients across 30 countries, with clients like Societe Generale, Bank of Africa, UBA, Ecobank, Bank ABC, and Natixis.
Could you tell us, Doug, why is infrastructure becoming a competitive advantage today in this landscape and with all these different challenges?
Why does this become a competitive advantage? Because the market is growing fast and it's going to keep growing. Bank account penetration across sub-Saharan Africa is expected to reach 68% by 2029. That's tens of millions of new account holders entering the ecosystem. The institutions that are infrastructure ready, when that wave arrives, they get the authorizations faster, they expand more easily, and regulators trust them. The ones that aren't, they spend 18 months rebuilding while the market moves without them.
To your opinion, Doug, what should fintech leaders do right now?
So I'll leave you with one question. Are you preparing for compliance, or are you architecting for it? Because in my experience across this continent, the fintechs that last aren't necessarily the ones that moved fastest from the start. They're the ones that built something regulators can trust. Map your architecture, find the fragmentation, test your audit trail, check your interoperability. Because regulatory readiness isn't a milestone you reach, it's capability that you build.
Well, that was very interesting. Thank you, Doug, for all this information that you provided. For sure, the SARB authorization is reshaping differently the infrastructure for fintechs in South Africa. Well, that was all for our first episode from our podcast. We're looking for sure for the next one. Please do not hesitate to subscribe to our MS Solutions Group YouTube channel and LinkedIn profile page.